Let's get to the solutions. Get that pen and paper ready. This is the exciting bit, all right? First of all, we're not right all the time as hedge fund managers, and I don't want you to put that pressure on yourself either. Okay, let me tell you, and I've shown this diagram before. Let's say the price is 100, and you think it's going to go to 120, or it might get as low as 80. You might do 100 trades. If you did 100 random trades, 50 will go up 20, 50 will go down 20. You'll make a net return of 0. You think, well, why, thank you, Alpesh. You found me a new way of not making money. All we're trying to do as hedge fund managers is go from 50-50, a coin toss, to 60-40. 60-40, not 70-30, not 80. Look, if I get a winning streak, toss a coin 100 times. Okay, sometimes you get a winning streak. If you get a winning streak, you might be right 10 times out of 10 for, I don't know, 10 times in a row, but not for 100 times in a row. We're only trying to be right 60-40. And guess what? That gives us a net return. That's something we can work with, because from that, we can scale up our capital and make more. Like I said, if you've got the skills to make 1,000, you can make 2. If you can make 2, you can make 4. And remember, each month, you're not guaranteed an income with trading. Some months you might make 2,000. You save the excess for the month in which you make nothing. So you iron out the ebbs and flows of capital so that you can get something more consistent, because we want to be consistently profitable. You'll have winning months, losing months. You save the money from the winning months for the losing months, and you iron it out, and you have a net positive return. That's all trading is. That's what it is. And that's where the mistake people have made. They've been trying to pay more and more money for the holy grail of trying to be right all the time. Bullshit. There is no right all the time. There's another solution. We're going to stay focused. If you can look, this is just happens to be one market chart. Could be anything. You, me, George Soros, the whole rest of the world all see the same data. Okay, we all see the same prices and the same data. We all have to make the same 2 decisions, when to buy, when to sell. So why is it that 80% of private investors lose money if they see the same data at the same time for euro dollar, for sterling, US dollar, and yet they still manage to lose money? Okay, so what we're going to do is we're going to switch that around. Surely if we can just get £100 from the market, we can get 1,000. If we can get 1,000, we can get 2, and so on. All right? And since we see the same data and we only have to make the same decision when to buy and sell, all we've got to do is become better at knowing when to buy and sell without being stuck in front of the screen. All right? It's as simple as that. Every trade is just a case of knowing when to buy, when to sell. Right? If that's the case, Alpesh, and you've made it sound stupidly simple, Alpesh, too simple, we're not foolish, right? In that scenario, trader 1, who might buy exactly the same time as you, might make £500. Trader 2 is a bit wealthier, might make £5,000. One of our investors in the hedge fund is Tom Singh, the owner of New Look. Somebody like Tom Singh, who also trades on his own account, might make £5,000, okay, in a trade, where one of you might make 500 because he's got more money. A professional fund manager might make 200,000 on exactly the same trade. So we want to learn all the same. We want to try and get the same data. We want to learn the same ability. So all we've got to then focus on is scaling up in our capital. The other solution we're going to use in this, and this is where I'm going to build up to the strategy part. The other thing we're building up is this. We use the simplicity of the biggest hedge funds. This is a slide I've stolen. I've actually stolen this slide, I say it, from Winton Capital. It is one of the biggest hedge funds in the world. All right, they are located in Hammersmith. They run about $35 billion. Winton Capital, they're called. And this is one of their slides of explaining to their investors what they do. It's ridiculously simple, isn't it? It's way simpler than any course vendor. A course vendor couldn't tell you this is how simple trading is, because you'd never pay them the thousands that they want to extract out of you. Right? So what Winton is saying they do is they see when a trend is about to start, and after a lag they buy, and after a lag they sell. Well, I know what you're thinking. Why is there a lag? Surely if they're clever, they can get in right at the market bottom and get out at the market top. No, they can't. That's bullshit. Anybody who tells you that they've got a time machine or a crystal ball to see the market tops and bottoms, there is no such thing as being able to see the market tops and bottoms, okay? There isn't, right? What you do is you have a lag, you buy a lag before you sell, all right? So we're going to copy this same simplicity. It's called momentum trading. It's called trend following, right? We're going to use the same principles as one of the biggest hedge funds in the world, because I think for private investors, this is the easiest way to trade. Now, I said we've got 10 different trading strategies into our 10 different algorithms within the hedge fund. Okay, I'm going to focus on the earliest, simplest one, which was given to me 20 years ago, more than 20 years ago, by Bill Lipschutz, who is this guy. That's Bill Lipschutz, hedge fund manager of the year last year. Okay, I met him 20 years ago for my book, Lessons in Trading Strategy from the World's Leading Traders. He was global head of foreign exchange at Salomon Brothers when Warren Buffett was his chairman. When I met him over 20 years ago, And Bill became a mentor. And one of the easiest and simplest and earliest strategies he taught me is the one I'm going to share with you. Oh, Bish, why are you sharing it? Well, to be honest, he shared it with me, and his wasn't a secret source that Salomons were using. He just said, this is the most appropriate for you as a private investor. It's not what they were doing, obviously, at the bank. It's something as a private investor which was suitable to me because I didn't have reams of analysts. They were making more money than I would with that strategy, but he's just giving a simplified version. That's all. It's like somebody saying, I drive a Ferrari, but here's a Ford Escort for you. The Ford Escort will still get you from A to B, a bit slower, but it'll still get you there. All right. And that's all he did. He gave me his Ford Escort, but it still gets you there. All right. So we're going to use him and a whole bunch of others. We're going to use the simplicity of what they taught me. And I tell you where that starts off, and I tell you how this simplicity kicks off. Okay. Kicks off with this. Okay. We need to have a plan of what and when and how often to trade, don't we? And this is what I'm going to suggest to you. I'm going to suggest to you, I want you to write these numbers down. Okay, that you should be spending no more than 15 minutes a day before and after work. Why 15 minutes a day before and after work? Because we found through our research, and I tell you, we research and experiment and use empirical evidence the hell out of everything. If you've read any of my books, you'll know this. Don't buy my books. There's not a plug for my books. I get about £1 in royalties on a £25 bloody book. Okay, so don't buy the books. I don't need the money. Give a donation to charity. I'm going to give you the best bits anyway of the books in this webinar for free. All right, at the end of it, I'm going to show you the links so you can download chapters and all the rest of it. 15 minutes a day. Why? Because when people are spending more time, they were doing lower quality trades. And it's about quality, not quantity. We want to scan 12 to 20 products. What are those products? I'm going to share them. You only need one screen. You can buy more screens if you wish, but you only need one screen. All right? One trade per day. Why one trade per day, Alpesh? I want to do more. You can do more if you wish, but one trade per day is what I'm going to suggest. That's going to be 20 trades per month. I'm going to show you on a business plan for yourself why that's going to be ample money for you. Okay? Not too greedy and not too little, okay? I'm going to show you why. These are the numbers, right? And what are the trades? And we're going to organize our trading screen like this. Remember, all this data is live, real-time, and free from many brokers. And when the brokerage section at the end of the webinar, I'll show you how to get it. Okay, we're going to set up our screen. So we've got, I've only got 12 up here, but I'll show you what they are and how. And then we can open up any of these windows. We scan them to see, does our strategy tell us that the market's going to fall like euros? Okay, and you can see it there. And I told you earlier, the euro we're short on. Okay, and there we are. We're still short, and it's falling. Now, notice how we didn't go short. That red arrow means to sell short, okay, which means we sell at that price in the expectation of buying it lower and cheaper later. Notice how we didn't sell right at the top. Well, so we haven't got a crystal ball. Neither has Winton, and they've got billions under management. All right, anybody who tells you, oh, we found the tops and bottoms, bullshit. All right, okay, so what are the products we're going to scan? Well, we want a good range of products where sometimes we're going long, sometimes we're going short. We're trading various timeframes, so we diversify across timeframes and also different products. Because guess what? The euro is not correlated to Facebook. So Facebook, we want to be trading alongside the euro. Why? Because then we're diversified. We're always making money. Okay, and you might even diversify across timeframes. You might say, oh, well, I'm trading Facebook 4 hour and 30 minute because I'm long on the 30 minutes, so I make money in the short term, but I'm short on the 4 hour, so I'll make money in the longer term. I'll come to all of that later, but I want you to understand how it all fits in. Rich people get rich because they've got access to lots of opportunities. So how many positions do we have open at any one time? Well, remember, one trade per day is what we're looking at. And the time frames that I suggest are the 30-minute and the 1 hour bars. And I'll show you why. Because even if you've got a day job, those are the best time frames to trade. Okay. What happens then when you mix all that up? You'll probably have 3 open positions at any given time. And one new trade per day is what you're opening. Okay, and I'll show you the maths on the business plan of how much money that will make you. But now you're starting to see, we're starting to put the jigsaw puzzle bits together about when to trade, how to trade. I'm going to put it all together for you, but I'm showing you it bit by bit by bit, okay? One of the other solutions we need to know is when to put our when to put our foot on the brake and when to accelerate. Now, I explain what I mean by that. Brake, I mean, how do we know when to get out of a trade at a loss? Accelerate means, how do we know when the trade's going in our way to keep going? How do we know those things? Now, before I do that, I'm just going to go back for 1 second to this slide. The timeframes we found, write this down because I've not written it on the slides. The timeframes we found when the trends, the movements are the smoothest, the best. In foreign currency, this isn't a webinar only about currencies, but in currencies, remember the markets for equities, indices, and currencies are open 24 hours a day, 6 days a week. Okay? In currencies, we found was after UK, because the currencies are traded 24 hours a day, 6 days a week as well, was after UK market close, was after basically 4 o'clock, 5 o'clock UK hours. Was a bit smoother. I'm not saying you should only trade those times. I'm just saying it's a bit smoother. The other things that we discovered was that, and I'll show you this later, 30-minute and 1-hour bars were the best, even if you've got a day job, and I'll explain mathematically why. Also, the best currencies, though I'll explain equities and so on in a second, okay, that we like are minor versus minor currencies and major versus minor. And we try and avoid, for beginners such as yourselves, major versus major. So what's a major currency? A major currency is only 4. Write it down. Sterling, euro, yen, and US dollar. Sterling, US dollar, yen, and euro. Okay, those are the only 4 majors. Everything else is minor. So we like major versus minor or minor versus minor, and we avoid major versus major. Got it? And the reason for that is we tend to think the trends tend to be a bit smoother for you. All right. Now, as I say that, I get a little post-it.